Ever stumble upon a dividend-paying machine that the market seems to ignore? Welcome to Insightful Value, where we bring you hidden opportunities in undervalued companies. Today's target, Crescent Capital BDC. The stock price is currently depressed, but is that a red flag or a rare entry point? Let's find out. As always, this video is for informational and educational purposes only and not financial advice. Crescent Capital BDC, ticker symbol CSAP, is a business development company that focuses on lending to middle-market U.S. companies. Their bread and butter? Senior secured loans and debt investments in companies that are too small for the bond market, but too big for your average small business loan. These types of companies often operate in recession-resilient sectors like healthcare, software, and services. From a value perspective, Crescent Capital BDC is trading well below book value, and yet it consistently generates solid income. That's already a potential mispricing that value investors should notice. In 2023, they reported strong net investment income and kept their dividend yield juicy, hovering around 10% paid quarterly. What makes this even more interesting is that the payout has been stable, and in some quarters, they've even issued special dividends. This indicates a level of confidence in cash flow generation. Revenue is driven by interest income from their loan portfolio, which continues to be well diversified. The company reported around $1.2 billion in total investments and maintains conservative leverage. Management has also been proactive about credit quality, regularly reviewing the health of its borrowers and adjusting exposures accordingly. Profit margins in the BDC space are tricky to compare to regular companies, but Crescent keeps operating expenses in check and delivers strong return on equity. And with rising interest rates over the past 2 years, floating rate assets have helped boost income. But here's where the risks come in. BDCs can be sensitive to credit cycles. If default rates rise among their borrowers, net asset value could take a hit. Additionally, their funding comes from a mix of debt and equity, so if the credit markets tighten or equity prices drop further, raising capital could become more expensive. Also, regulatory limits on leverage, usually 2.1, mean they can't just keep expanding the portfolio without balance. Still, Crescent has been managing these headwinds responsibly. They've shown restraint on portfolio expansion, kept a conservative debt profile, and have a deep relationship with their sponsor firm, Crescent Capital Group, which manages over $40 billion in assets. So why is the stock trading low? Partly it's market sentiment. BDC stocks often get punished during periods of economic uncertainty, but if you're investing for income and buying below book value, that could represent an upside opportunity with limited downside. At Insightful Value, we specialize in digging into companies like this. We take all the raw financial data, filter the noise, and give you the insights that actually matter. Whether you're just building your portfolio or already deep into value investing, we break it down simply and effectively. More information about Crescent Capital BDC and other undervalued stocks is available at insightfulvalue.com. You'll find in-depth reviews, risk breakdowns, and tools to help you become a sharper investor. And of course, don't forget to subscribe to our channel and visit insightfulvalue.com for more data-driven investing ideas. See you in the next one.